When the Roman economy collapsed, women often stabilized households, rationed food, and ensured survival. In medieval Europe, this pattern repeated itself in quieter tones. Although the guilds and trade routes officially belonged to men, the hands behind the looms, bread, herbs, and markets belonged to women. Widows became business owners, running inns, bakeries, and textile shops. By the 14th century, women made up nearly half of the labor force in England's most profitable industry, cloth production. Yet history called them helpers, not entrepreneurs. In reality, women were the backbone of the medieval economy. When disaster struck, when men marched off to war or plagues emptied cities, it was women who rebuilt. Every crisis opened a door that society had tried to keep closed. The Black Death killed millions, but afterward women filled jobs that had once been barred to them. They earned wages, ran farms, and shaped local commerce. Time and again, the pattern held. When the system collapsed, women repaired it. Then came the greatest economic earthquake of all, the Industrial Revolution. Steam engines and machines promised progress. However, for women, progress meant working 14-hour shifts in factories for half the pay of men. Yet even amid the soot and steel of industrial cities, women discovered something the world did not expect: financial awareness. For the first time in centuries, millions of women received wages, small and unfair, but theirs. With that came a radical shift. They began saving. They started calculating. They began dreaming. In 19th century England, ladies' savings banks were founded. Safe spaces where women could deposit their earnings, quietly rebelling against financial dependency. Although the system saw women as cheap labor, they were becoming financial actors. They were learning how money moved, how it grew, and how it could buy freedom. Then came war, the ultimate test of an economy. World War I took men away from factories, fields, and offices. Women replaced them overnight. They produced weapons, grew food, drove ambulances, and managed entire industries. They also financed the war itself. Across the United States and Europe, women led Liberty Loan campaigns, convincing families to purchase war bonds and raising billions of dollars. They were no longer behind the economy. They were steering it. When the soldiers returned, however, the world tried to push women back into the kitchen. However, something irreversible had changed. Women had discovered their own power, and they would never forget it. 2 decades later, World War II made this change undeniable. Rosie the Riveter became a symbol, yes, but behind her image were millions of real women who managed both home and factory, budget and bond, grief and growth. They didn't just keep economies alive. They prevented societies from collapsing psychologically. Behavioral economists now call this phenomenon stability bias. Back then, it was simply resilience. The 20th century became a century of awakening. Women entered universities, studied economics, and began to challenge financial theory itself. At Cambridge, Joan Robinson questioned why classical economics ignored unpaid labor, the foundation of every household economy. Meanwhile, laws began to shift. In the United States, for example, the Equal Credit Opportunity Act of 1974 finally allowed women to obtain credit cards and loans without a male cosigner. This may sound absurd today, but just 50 years ago, financial independence required permission. From that moment on, finance was no longer exclusively a male domain. Women became investors, fund managers, and entrepreneurs. In Japan, women-led savings circles evolved into microloan systems. In Latin America, women-run cooperatives funded education and community farming. The feminist movement wasn't just social, it was financial too. By the dawn of the 21st century, the narrative had flipped. Rather than asking to participate, women were leading. Christine Lagarde rose to lead the International Monetary Fund, and later the European Central Bank, guiding entire continents through financial crises. Ngozi Okonjo-Iweala became the first woman and the first African to lead the World Trade Organization. Their leadership style was different, more collaborative and less reactive, and markets took note. Studies began showing that companies with more women in leadership perform better not only ethically, but financially as well. Women-led startups generated higher returns per dollar invested. In the world of consumer behavior, women were influencing over 70% of global spending. The female economy had arrived, not as a demographic, but as an economic engine. Yet perhaps the most transformative change came from the ground up. In Bangladesh, microfinance pioneer Muhammad Yunus discovered what global banks had overlooked. Women were the most reliable borrowers. Through tiny loans, millions of women lifted their families out of poverty, proving that trust is more powerful than collateral. In Africa, women's cooperatives began managing supply chains for cocoa, coffee, and shea butter, transforming local craftsmanship into international trade. Across India, women organized self-help groups that educated each other about credit, budgeting, and entrepreneurship. The impact rippled across generations. When women controlled resources, children's education rates rose, community health improved, and entire regions became more stable. Economists now recognize this phenomenon as the multiplier effect of female income. Despite all this progress, the gap remains. Women still earn less, invest less, and remain underrepresented in boardrooms and hedge funds. However, this isn't a story of victimhood. It's a story of transformation. While men historically built systems for profit, women are redefining finance around purpose. Behavioral studies reveal fascinating differences. Women investors tend to make fewer trades, avoid emotional reactions, and focus on long-term stability. They're less seduced by quick wins and more focused on security and sustainability. In volatile markets, this mindset has become a superpower. It's no coincidence that funds managed by women have shown greater consistency in returns during crises. The same instinct that once balanced family budgets now balances portfolios and nations. In many ways, the modern era, and with all its talk of AI, cryptocurrency, and sustainability, is returning to the oldest economic truth. Trust is everything. Trust has always been women's strong suit. As we move deeper into the digital age, empathy, foresight, and ethical reasoning will be more valuable than speed or speculation. These are not soft skills. They are survival skills, and women have been practicing them for thousands of years. From priestesses managing temple accounts to economists shaping global policy, women have always been the moral compass of finance. In the face of climate crises, inequality, and financial uncertainty, women are once again at the center of reinvention. They are leading the push for sustainable investing, ethical banking, and community-driven growth. They are the architects of an economy that measures success by more than just GDP. They measure it by well-being, too. The same quiet resilience that once rebuilt economies after war now propels a new kind of capitalism, one grounded in inclusion and equilibrium. When we talk about the history of money, we're not just talking about coins, markets, or kings. We're talking about the mothers, workers, healers, and dreamers who kept the system alive when it should have collapsed. The truth is that the economy has always been feminine at its core, cyclical, nurturing, and adaptive. The future of finance may be digital, but its soul will remain deeply human. As we step into that future, women, the silent architects of history, are finally stepping into the light, not as the backdrop of progress, but as its authors.